Fuck, or just realize Canada wants you to be rich. Canada is one of the easiest countries on the planet to get rich. Woo! Baby. To my surprise, my dividend stock portfolio recently just hit an all-time high of over $392,000. It's been a good several months since we've said that, and a lot of this comes from cost averaging into the market over the last few months. So I thought it'd be really fun, really prudent, and really fruitful to actually break down not only the overview of the portfolio, but take a look at all the individual accounts from my RRSP, my TFSA, those tax advantage accounts, to my corporation itself, and then explain to you my own personal working circumstance and how I utilize all of these accounts to get basically rich, because Canada does want you to be rich. People just don't know how to implement the tools that are provided, because ain't nobody teaching this in school. So this might be one of the greatest, most golden nuggets of truth videos I've made in a while. So if you can appreciate that, hit that like button, folks, because let's start first and foremost with the overview itself. Taking a look, guys, the account is primarily being driven by my dividend ETF VDY, which recently just hit green for the year, which is a bit of a surprise to me, followed by VYM, which is also just close to being green on the year. Obviously lacklustering performance out of VOO, SCHD, giving my account value about $367,000 plus the $24,000, $25,000 I have sitting in cash, giving me that $392,000 mark, which again, I think is an all-time high. I mean, I didn't even come close. I was just getting close to this about several months ago. So prudently cost averaging is really paying off in this market, whether it's a bear market rally, short-lived, who the hell knows, Christmas rally. We'll see what, 2023 brings. But nonetheless, if you guys do like this portfolio spreadsheet because it combines all my individual brokerage accounts into one place and tracks it automatically, support the channel at portfoliospreadsheet.com. I'm going to be releasing portfolio trackers on Excel, on Google Sheets very soon, which you can automatically get for free if you already purchased the iCloud version of this sheet. So thanks for those that have already supported. But let's get into the individual accounts and let's break down tax advantaged accounts and start really refined, really simply before we start talking about the technical tax advantages of corporate investing and opening a corporation. First and foremost, my TFSA, the tax-free savings account, which for those of you that are noobs here in investing in Canada, this account basically allows you to make money. You pay taxes on your working income. If you put that money into this tax-free savings account, anything that gets made in this account, so all your capital gains, all your dividends, are 100% tax-free that you can draw against at any point in time in your life. This thing is a gem, a golden endless provider of passive income. My account in this TFSA is worth $158,000. I've spent several years building this up. And if you want to know how much you can contribute to this account, because it is limited, go to CRA login, log into your CRA account, scroll down the left side, and it'll show your RSP and TFSA room. I always recommend maxing these accounts before doing anything else. But we can see in this account, I do have VDY, about 60,000 sitting in this stock, which is actually up about $1,000 or about 1.84%. And we can see I have VOO in here, which is probably my largest VOO position, worth around 73,000 US, which is currently down about 2.31% since I've been cost averaging into it. Now, we in Canada and in the US, if you're buying over the border stocks, you will get taxed 15%. It's what's called withholding tax. So I wanted to focus on a more growth oriented ETF in this account for my US holdings, because that way I'm not really too focused on the dividend income and this is the only caveat in this tax-free savings account, is any of those US dividend stocks, you'll lose 15%. So it's probably more prudent to own growth-based US stocks or really broad-based ETFs that don't maybe pay as much of a dividend. But that's my TFSA. Now, we also have the RRSP, which is a registered retirement savings plan. This one operates a little differently because the money you make, any money that you're allowed to contribute to this account, will defer the taxes. So if you made money that was taxed and you put in the contribution room, all that money you put in here, you'll get that tax deduction. You'll actually get a tax return if you already pay tax on that money. And currently this account is worth $67,000. And also, just to explain as well, when you go to pull the money out, it's a tax deferred account. So you won't pay the tax until you start withdrawing it. At that point, you're only charged your nominal tax rate. So this is also a really beautiful account. And we can see in here, I hold SCHD and VYM, which I'm currently green on both of these, performing very well since I've been cost averaging into them. And you'll see that I primarily hold my dividend ETFs within this account. That is because there is no withholding tax. I don't know how the government gets away with this. I don't know why it is, but any US dividends, any foreign dividends made in this account there's no withholding tax. So obviously it's more prudent to hold your dividend stocks or your US dividend stocks within the registered retirement savings plan. Now, again, if you are a noob to getting rich in Canada, max these accounts out. The US doesn't even have tax advantage accounts like this. They're 401ks and Roth IRAs. If you draw against them early, you get like penalized for it. In these accounts, you don't get penalized. So max them out. Log into your CRA account, damn it, and start here. As soon as you get these maxed out, then you can start taking advantage of some of the stuff we're about to talk about. But firstly, I also have a regular brokerage account, which in this account is worth about $51,000, $52,000, and I just hold my regular Canadian dividend stocks in here. Again, this is a fully taxed account, so I pay my nominal income rate on all the dividends, which is why I'm not going to hold US dividend stocks in here, because again, I'm going to be paying 15% withholding plus my income tax bracket. You lose anywhere from 30 to 40+% of the income. Not really the most prudent thing you can do, but again, you can also just take those dividends and contribute them to your RRSP every year, which would waive the entire income taxes from these Canadian dividend stocks, which you can see I own things like Fortis, TELUS I recently bought, RioCan, Smart Center, some of those real estate investment trusts, which are great for passive income, that monthly income. We also got a little bit more VDY in here as well. But let's kind of pivot into the more technical, the more complicated corporate investment account. Now, before I show you the account, I do want to make sure you understand the only reason you're going to start opening up a corporation is firstly because you've maxed all these accounts. Secondly, because you have self-employment income of at least over $50,000 a year. Is I have full employment income. I have a full-time job, fully taxed, all that stuff, but then I have self-employment income and I've separated them nicely. It's kind of the best of both worlds, because if you're running a corporation, you can't use the money the corporation makes to say, hey, I made this money. The bank, if you're applying for a mortgage or trying to buy real estate, they'll only look at your personal income unless you're doing it through the corporation. Then they'll look at the corporation's personal income. Plus, you're not paying into that CPP, the Canadian pension plan, on your regular income job. Part of that goes to CPP, which is, a retirement account for when you're 65 that the government auto does for you. So again, just kind of take that into perspective. Here's my corporate account, guys, worth about $90,000. In this account, I do have VDY and I have VOO. So again, these ETFs are spread across all these different accounts. Now, what I do with my corporation is when I make money, I firstly use it for corporate write-offs. Let's say you want to buy a brand new Mercedes. If you were going to do that in your own personal name, a $100,000 car, well, you're probably going to have to make about $130,000 because you're going to be taxed at about 30%. And then on top of that, you're going to be paying HST, GST, and taxes on the sale of buying that Mercedes. Whereas in a corporation, is that money, the car, considered a corporate expense? You're using it for business reasons. You will not pay any income tax on the money the corporation made to buy that Mercedes. It's complete tax write-off. It's such a beautiful thing, but in a simple perspective, a lot of things you use in your daily life are things you also need for your business. Some of your food, your lunches, some of the square footage of your apartment, your house that you're using for office space, your phone bill, your internet bill. That's what I'm doing to save myself the personal income tax liability. Now, any money left over after the tax write-offs is going to be taxed at the corporate tax rate. This is where Canada really wants you to be rich, because the corporate tax rate is only like 10%, 13% on the first $500,000, which is wild because you couldn't do that in your own personal name. In your personal name, you're already taxed at like 20+%. But finally, you paid those taxes, you've done the bullshit, you got some money left over, you can open up a corporate investment account, which we can see here. And I want to talk about some of the loopholes and some of the things that I've learned, because obviously this is taxed a lot higher. The Canadian government's like, hey, we're already giving you so many damn tax breaks. If you're going to make passive income in your corporation, we're going to tax that passive income at 50%. A lot of people threw that in my face. They're like, oh, Kyle, what's the point? You're taxed so much on these stocks. The caveat here, and something I learned with my accountant, is if you pay yourself the dividends you make in this account, guys, all of a sudden, like paying it into your personal name, you get a dividend tax credit, which completely waives the passive income tax. Now you're just paying your nominal normal income rate at your regular job. But if you take those dividends, you put it in your personal name from your corporation and then put it into your RRSP, boom, loophole, zero taxes paid. Because unfortunately, all passive income, if you hold stocks for over a year, capital gains and dividends will be taxed at around 50%, which sucks, which is why I'd rather focus on dividend income than growth, because inevitably if you sell growth, it's going to be hard to put all of that in your personal name without paying like crazy taxes because you only have so much room to contribute to your RSP. My primary goal with this corporation, guys, is to make it go forever. I'm never going to liquidate this. I'm never going to pull the money out into my personal name. I'm going to use it for corporate tax write-offs. That's really the most prudent stuff. But the best thing about having a corporation, why everyone should open a damn corporation, it's not easy. It's a lot of paperwork. You're going to have to find yourself, a corporate accountant. It costs a little bit more, but the liability reason is why you want a corporation. So if you divorce your wife in Canada, I don't know about the US with Jeff Bezos, that stuff, right? But in Canada, your wife can't really go after what's in the corporation. It's a separate entity in and of itself, right? However, if you love your wife, you love your family, you pass on at some point, you can actually give all of your shares and basically make the successor to the company your wife, your family, and they just get the immediate shares to the company and do not have to sell any of the assets in the company itself. It's really awesome because in your personal name with a TFSA RRSP, you have to do a lot of liquidation, a lot of tax stuff comes into play. It's a mess, it's complicated. So there are a lot of different features that come into play here that have really made me or just realize Canada wants you to be rich. Canada is one of the easiest countries on the planet to get rich in. God, guys, it becomes life-changing stuff, and I hope you learned something. Let me know what you think in that comment section below.